Interest rates had been stuck in a rut with just about no volatility for the last few weeks. That is until yesterday, when speculation about the Bank of Japan possibly changing its strategy on monetary policy, sending treasuries falling and rates shooting higher. As those rates have been generally forecast to head higher, we took a look at the S&P 500 index and found the highest yielding stocks there. Are these names that are at all attractive to traders on the hunt for yield? There are currently around 13 stocks in the S&P that have dividend yields that are north of 5%. Some are in traditionally yield-rich sectors like the real estate investment trusts, Macerich or Ventas, with a 5.2 and 5.5% yield respectively. Or how about a couple of consumer discretionary stocks that have hit harder times as of late? You've got Ford, also L Brands. Ford currently has a yield of 5.7% and L Brands has a 7.7% yield. The yield hunt, though, a tricky game. What is that balance between price depreciation and the safety of the current dividend? Interest rates, of course, on savings accounts, certificates of deposit, and other cash instruments are on the rise. According to Bankrate.com, you can currently find a one-year CD yielding around 2.5% and five-year CDs yielding around 3%. Melissa, there may actually now be some risk-adjusted competition for higher-yielding stocks. Back over to you.
All right, Dom, thank you. Dom, you in the newsroom. So given the numbers, we thought this would be a great time to play
another game.
Yes.
What's this?
Yield hunting. This, if you can believe, is one of our more controversial games here on the desk. But I know our viewers at home are very smart and they can follow along. Here's how it works in case you've forgotten. Let's take L Brands, for example. 7% dividend yield. If the traders like it, they will say bullseye. And you see and you hear this. If they do not like it, they will say let it go. You'll see and hear this. Okay, makes sense?
So intuitive.
Karen's taking notes.
Karen's,
okay,
yeah,
it's time to go hunting.
Sure.
And Karen, we will start off with you. I have every confidence you will play this game properly. L Brands is the example. Dividend yield of 7%.
Bullseye. I don't love things because of the dividend yield. This one I actually think is so cheap. They do spend a ton buying back stock. If anything, I think they could tamp that down if they wanted to keep the dividend yield. So bullseye.
That was perfectly played.
I got to tell you, I'm going to try to do the same. Bullseye, because I actually think this company's gotten too cheap. We know what's going on in Victoria's Secret. Bath & Body Works is actually doing quite well. I think the sentiment around this discretionary play, I've seen it go on in the sector. I think the stock's making a turn, earnings in about a month, and I think they're worth playing on.
All right, let's go to Ford, 5% dividend yield. David Seaberg, what do you say?
Look, I mean, I'd buy Ford here. Again, I don't love to play stocks. Oh, whatever, bullseye.
Amazing.
Look,
have you not been listening to any of us?
I think that this is a name where, again, I don't buy just stocks for the dividend, but this is a name that's following GM's playbook when it comes to their self-driving car program. I mean, they could actually get some third-party investments that could actually spook this up. This is a name that's worth buying here, given its valuation. So I would be a buyer of Ford.
Guy Dami, Ford.
I would say, what's the other thing? The bullseye or?
Let it go?
Let it go. Let it go. Let it fly the duck. I don't know why let it go. I mean, if Ford hasn't rallied, the last 6 years have been the best in the history. I mean, the market goes straight up. Auto sales through the roof. Ford can't get out of its own way. You explain that to me. So if Ford can't go higher now, when is it going to go higher? So shoot the duck, lose the bullseye,
you don't
move on.
Let it go. You don't shoot anything. You're letting it go.
What do you mean?
It's a good thing we don't make operating systems for phones and things. We need to be intuitive, right? Any way at all.
All right, moving on. Ventas,
yeah, just in
5% dividend yield. Tim.
Right. So the REIT world, these guys are heavily in the healthcare field, preventative care. I actually think that their history in allocation, capital allocation, is very, very good. But this is not my type of investment. I actually don't buy things for yield. I'm going to let this one fly.
Let it go.
Enough.
Whatever. Are you serious?
It's very close. We understand what you're saying. All right, and Guy, we're going to back to you. How about going down to the bank and putting your money in a one-year CD at a rate of 2.5%?
That's what I got, a one-year CD at 2.5%. You ever seen the movie Run Silent, Run Deep? Remember that? It's probably. I mean, I love that movie.
Can you just tell me why you're
mentioning it? Well, it's a submarine, and you put the crosshairs on your target. So bullseye on that one.
Go bullseye on
I mean, that's free money. That's free. 1 year, 2.5%.
For one whole year, you're going to lock your money up for just 2.5%.
10. What's the 10-year now? 3%. I mean, better 1 year, 2.5 than 10-year.
The Fed goes 2 more times this year, and you buy in a 2-year note that's north of 3%, and you probably have an environment where we're going to slow down the economy.
So he's shooting it. So he's letting it go.
I'm just telling you why. You know, you're locking in. You're locking in.
If you can do 2.5%, maybe that's telling you
But you can
something
go shorter
about
duration,
equities.
maybe. No?
That's not the game. That's a whole different game. Where do you
Sorry,
bring that
I'm not
up
playing the
from?
game right either. I'm just,
Crosshairs, bullseye.
All right.
Back to you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.